Now to our daily segment highlighting the best of Bloomberg intelligence. Of course, equity strategist Michael Casper joining us now, really to walk us through that market pulse index. And Michael, I'm taking a look at the market pulse index here. Patience, panicking, but better times ahead. Walk me through that.
Yeah, so the market pulse index is meant to be an index that quantifies sentiment. So we have 6 factors that go into it: low versus high vol performance, low versus high leverage performance, defensive versus cyclical sector performance, and then price breadth, high yield spreads, and pairwise correlations. So these 6 signals come together to form an index that ranges from 0 to 1, 1 being manic, 0 being panic. And the index as of September hit a 0.08 reading, which is the lowest level, since 2011 or 2015, and is actually only matched by 4 other periods, including November 2008.
Okay, so remind me, 0, no panic, or 1 is manic, or the vice versa, and talk to us about the longer term outlook, therefore, when you start to read these sorts of indices that you're developing.
Yeah, so 1 is manic, 0 is panic. So we're very close to almost a complete washout where the market is completely panicking. The only signal that registered neutral was the defensive minus cyclical sector performance. But what happens after that, and I mentioned those 4 instances where this level's been met, 3 out of 4 of those, obviously November 2008 was no good, but 3 out of 4 of those resulted in outperformance or gains for the Russell 3000 and outperformance for small caps over large caps. Historically, whenever we hit what we call a panic signal, so anything below zero point 0.4 on that index, the Russell 3000 has outperformed gained 9.1%, while the small caps have outperformed large caps by 140 basis points. So panic is actually a counter signal, signaling higher equity returns and small cap outperformance over large.
Michael, on this program, I always talk about historical references as well. And Romain, who we should mention has the day off, then corrects me and says historical references don't work when there are structural shifts in the economy, inflation, a Federal Reserve on the move. Do you trust some of those historical signals that you're watching?
Yeah, the signals proved time and time again that panics usually lead to better times ahead, and same things with manic periods, right? So when the signal is very high, equity returns are about average, and small caps typically underperform large caps because that's usually a signal of defensive sentiment emerging when the market gets too manic. But yeah, we tested it all the way back to 1999, and the signal's been pretty consistent.